Higher for longer interest rates, an intensifying AI investment boom, and a fragile energy backdrop are pulling portfolios in different directions today. This is vTalkInsight, Allocator's Lens Daily for May 22nd, 2026. Let's start with equities, where the AI complex is still doing the heavy lifting for global risk appetite. In equities, the central tension is between extraordinary AI-driven strength and growing signs of froth and concentration risk. Big tech earnings remain powerful, with flagship AI hardware and cloud platforms delivering repeated upside surprises, supporting upgrades to broad equity benchmarks even as macro uncertainty persists. Optimism around AI is global, with strong results from leading chipmakers and memory suppliers fueling sizable gains in parts of Asia and reinforcing the sense that this cycle is broader than just a handful of U.S. names. Beneath that strength, leadership is increasingly narrow. A small cluster of sectors tied to AI and tech continues to dominate index performance, while areas more exposed to inflation or higher oil prices are seeing downgrades and relative underperformance. Positioning is crowded in equity markets most associated with the AI theme, including the U.S., Taiwan, and Korea, raising the risk that any shock to the narrative could trigger sharp reversals rather than a general rotation. One composite risk gauge now shows nearly all of its froth signals flashing, pointing to an elevated correction risk just as new issuance is ramping up. Semiconductors sit at the heart of this story. Earnings in the AI supply chain are exceptionally strong, with some companies delivering more than 80% revenue growth for multiple quarters and gross margins around the mid-70s, levels rarely seen at this scale. Yet valuations in parts of the chip complex have stretched well beyond technical trends, and sentiment is near peak, leaving these stocks vulnerable to profit-taking even when results beat expectations. A leading AI chip maker just posted another large beat and raised guidance, confirmed sustained demand, and announced a substantial buyback, but the share reaction has been muted and relative performance has lagged its own sector this year, underscoring how much good news is already embedded. The next test for equities may come from the primary market. A wave of mega IPOs from AI and space leaders, including OpenAI, Anthropic, and SpaceX, is lining up, with some deals targeting record-breaking valuations and raising tens of billions in fresh equity supply. One prospective listing could even rival the largest IPO in history, while another is being floated at revenue multiples that would push the boundaries of what public markets have historically tolerated. Governance is another fault line, with some structures leaving founders with very high control and prompting large pension funds to prepare for more assertive shareholder engagement once these names enter major indices. At the micro level, corporate profits remain broadly robust, helped by government spending and resilient demand, but the consumer picture is splitting. Luxury sales are beating even optimistic expectations, and overall store and restaurant traffic is strong. Yet lower-income households are feeling the pinch from fuel costs, with average gasoline fill-ups dropping below prior norms. Retailers exposed to these pressures are seeing margin drag from higher fuel, in some cases shaving a couple of 100 basis points off operating income growth, even as they lean on higher-margin businesses like advertising and marketplace services to support guidance. All of this is happening as rising bond yields and a potential second leg of the energy shock threaten valuation multiples. Recent equity softness has coincided with another move higher in front-end yields and renewed inflation concerns, echoing the dynamic that drove the 2022 D-rating. Implied equity volatility remains contained in the mid-teens, which contrasts with a number of froth and concentration signals now blinking, so a rates or oil surprise could have outsized effects. For allocators, the equity story hinges on whether AI earnings and IPO enthusiasm can keep offsetting the drag from higher real yields and energy costs. To gauge that, the key watch points are market breadth, AI-related earnings revisions, the IPO calendar, and bond and oil price move from here. Those rate dynamics are where we turn next. In rates, the dominant theme is a steady shift toward a higher-for-longer stance as inflation proves stubborn and growth stays resilient. Recent Federal Reserve communications show internal debate about keeping any easing bias at all, with several officials leaning toward removing it, effectively signaling that rate cuts are off the table until the data clearly deteriorate. Commentary stresses that cuts depend on convincing evidence of labor market weakness, which is not materialized, while markets have already priced out most expectations of easing this year and are starting to entertain the risk of an additional hike. Yields across the Treasury curve, from 2-year notes through 30-year bonds, have pushed higher again, and global government bond yields are approaching levels not seen since before the financial crisis. Importantly, recent sell-offs have been driven mainly by rising real yields rather than a jump in inflation expectations, suggesting investors are reassessing the structural inflation backdrop and the level of neutral rates. Underlying inflation cycles are trending upward across major economies, and core measures remain on an upward path, with some expecting core personal consumption expenditures inflation to print in the low to mid 3% range, keeping central banks on alert. Structural forces are adding to that pressure. Record fiscal deficits, heavy government borrowing, and surging capital needs from AI data center buildouts and other infrastructure are all increasing the supply of duration the market must absorb. Corporate AI-related capital expenditure has jumped by around half year-on-year, and governments are also deploying equity and grant capital into advanced technologies such as quantum computing, reinforcing the sense of a long-lived investment cycle. On top of that, economic nationalism and reshoring are expected to keep term premia and rate volatility elevated over the coming decade, while some warn that cutting rates too aggressively could risk losing control of long-end yields entirely. The impact on the real economy is visible. Mortgage rates now embed the equivalent of roughly 2 extra Fed hikes, which is weighing on housing. Starts and completions are weak, and the key spring selling season has passed without a strong rebound. At the same time, there is now meaningful yield cushion in parts of the front end. For example, 2-year treasuries are seen as able to absorb several hundred basis points of further rate increases before total returns turn negative. Municipal bonds stand out as offering multi-decade high yields relative to treasuries for high-tax investors, adding another layer to the discussion about where to take interest rate exposure. The main risk in rates is policy error in either direction. If political pressure stops central banks tightening even as inflation cycles reaccelerate, volatility could rise sharply and bond markets may force a faster repricing. Conversely, a meaningful slowdown in growth or a stall in the AI capex boom would likely restore some of the diversification benefits of duration and challenge the higher-for-longer narrative. For now, allocators are watching labor and inflation data, deficit debates, and central bank rhetoric, as these will set the tone for how far real yields can climb before something breaks in credit or growth, which is where we turn next. Credit markets sit at the crossroads of this higher-yield world. Investor demand has been rotating away from treasuries toward corporate credit, where higher base rates translate into attractive all-in yields. Spreads remain tight despite rising benchmarks, and high-yield markets offering yields in the mid-single to high single digits continue to draw interest, especially from those seeking both income and exposure to AI-linked growth stories. Investment-grade bonds are increasingly viewed as a relative haven from long-duration treasury risk, reinforcing demand at the top of the capital structure. Beneath the surface, however, credit quality is starting to fray. Corporate and household balance sheets show early signs of strain, with leverage metrics drawing comparisons to the early 2000s. Many highly leveraged borrowers face a challenging refinancing environment as they roll debt at significantly higher coupons and, in some cases, wider spreads, raising the risk of equity value erosion and a higher chance of a hard landing if earnings disappoint. This vulnerability is compounded by the same higher-for-longer yield backdrop that is supporting all-in returns today. Market structure adds another layer of risk. Passive investors are absorbing large volumes of new investment-grade issuance with limited scrutiny of underlying fundamentals, and some longer-dated, more speculative structures do not appear to offer adequate compensation for their risks. In high yield, demand is being supported by passive and quasi-passive flows, which could reverse quickly if liquidity tightens or sentiment shifts, potentially transmitting stress across risk assets. Private credit and private equity are also under pressure, with high-profile losses, slower exits, and significant undeployed capital prompting allocators to question the resilience of private market return assumptions in a sustained high-rate regime. For allocators, the credit picture is a balance between compelling carry and rising fragility. Each incremental move higher in yields tightens the screws on the weakest balance sheets, even as it improves prospective returns for new lenders. Key indicators to monitor now include refinancing activity, default and distress ratios, earnings trends outside the AI leaders, and the behavior of credit spreads during the next bout of equity or rates volatility. These will help signal whether credit remains a resilient income engine or becomes the transmission channel for the next risk-off episode, feeding back into FX and alternative yield markets. In currencies, the higher-for-longer U.S. rate profile continues to underpin the dollar's role as a global anchor, particularly against economies more exposed to energy imports and weaker growth. Alongside traditional FX, a parallel search for yield is playing out in digital assets. Bitcoin's supply from miners is increasingly being absorbed by institutional buyers and by crypto-linked credit products, reinforcing a narrative of structural scarcity over the long term. This links crypto pricing more tightly to institutional balance sheets and credit conditions than in prior cycles. Tokenized yield products are another important development. A prominent tokenized preferred stock structure has gathered over $10 billion in assets in less than a year, offering tax-deferred yields well above traditional money markets and growing at a rapid annualized pace. Market participants see potential regulatory clarity, whether via new legislation or updated securities guidance, as a key catalyst for broader adoption of tokenized securities and may open the door to more crossover between on-chain and traditional credit markets. For multi-asset portfolios, this means currency and digital asset markets are increasingly intertwined with the rate and credit complex, rather than sitting on the fringe. Differences between on-chain yields, front-end curves, and traditional credit spreads, as well as any major regulatory moves, could influence where global liquidity flows and how quickly risk sentiment swings. That backdrop makes the next moves in commodities, particularly energy, even more important for both inflation and cross-border capital flows. Commodities, and energy in particular, remain the key macro swing factor. Crude inventories are being drawn down rapidly, with some regions in the U.S. and Asia projected to approach operational tank bottoms by late June if current trends persist. Despite that tightness and renewed geopolitical tension around Iran's nuclear posture, benchmark crude prices are hovering just below recent highs, suggesting markets are not fully pricing the risk of more severe supply disruption. That leaves asymmetry. A relatively small additional shock could provoke a disproportionately sharp move higher in prices. Under the surface, a sizable deficit in oil balances is being masked by ongoing inventory draws, raising the prospect of localized shortages in key consuming regions within weeks if supply issues are not resolved. At the same time, liquidity in crude financial markets is thin and confidence among participants is fragile, constrained by inconsistent information and geopolitical uncertainty. This combination of physical tightness and low market depth increases the odds of volatility spikes and can deter fresh risk-taking just when hedging demand is rising. Geopolitics and policy are central to the outlook. Negotiations between the U.S. and Iran remain difficult, and while there have been periods of reduced tension, unresolved issues over uranium exports keep the risk of renewed flare-ups alive. The U.S. has been releasing strategic reserves to cushion fuel prices, but once that buffer is drawn down, the full consumer impact of higher crude and product prices could become more apparent. Meanwhile, delays to shipments of key inputs like fertilizer and sulfur through choke points, such as the Strait of Hormuz, raise the possibility of downstream disruptions to agricultural output later in the year. Corporate earnings are already feeling the effects. One large U.S. retailer reported that higher fuel costs reduced its operating income growth by roughly 2.5 percentage points in the latest quarter, even as it maintained guidance for solid single-digit operating income growth by leaning on higher margin services. Companies with less diversified business models may find it harder to absorb that kind of shock, particularly those serving more price-sensitive consumers who are already cutting back on fuel volumes. Persistently high gasoline, diesel, and jet fuel prices are also feeding domestic political pressure, which in turn can influence foreign policy decisions and, by extension, future supply risk. For allocators, energy remains the key swing variable tying commodities back into rates, equities, and credit. A renewed spike in oil could reignite inflation concerns, push bond yields higher, and squeeze profit margins, while surprise softening would relieve some of that pressure but not fully resolve underlying core inflation trends. Watching inventory data into late June, Developments in Iran-related diplomacy, strategic reserve policy, and freight bottlenecks will be critical to assessing how much of the energy risk is truly priced across asset classes. Those crosscurrents set the stage for our final wrap-up. Across assets, the picture is one of powerful structural growth forces colliding with tighter financial conditions and rising policy risk. Equities are riding an AI and tech earnings wave, but leadership is narrow. Valuations in key segments are stretched, and a looming mega IPO calendar will test liquidity and governance tolerance, just as real yields and energy costs edge higher. Rates are converging on a higher-for-longer regime, with deficits, AI capex, and deglobalization lifting term premia, while credit offers attractive income, but masks growing leverage, refinancing, and flow vulnerabilities in both public and private markets. FX and digital assets show a broadening search for yield, and tight oil markets keep the risk of an inflation aftershock alive, with potential feedback into every other asset class. For multi-asset allocators, the key is to monitor how long-end yields, energy inventories and prices, AI-related earnings and capex, credit spreads, and regulatory signals around tokenization evolve together, as these will shape the next phase of cross-asset repricing. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.